The yield curve allows investors to compare the returns of bonds from the same issuer but with different maturity dates. Investors and other market participants also use its shape and movement to help forecast future interest rates. The yield curve plots the yield to maturity, or YTM, of bonds from the same issuer against their maturity dates. For example, the government yield curve plots the current YTM of bonds issued by the government of a given country against their maturity dates. This usually ranges from short-term bonds with maturities of 12 months or even less to longer-dated bonds with 20 or even 30-year maturities. Lower yield to maturities are usually associated with bonds with shorter maturities, and higher YTMs with longer maturities. Here is the US Treasury yield curve, showing the YTM of bonds issued by the US government. The yellow plot shows the yield curve in September 2018, while the green plot shows the yield curve in March 2019. In September 2018, yields on short-term treasuries were lower than yields on long-term treasuries. This makes sense, as usually there is less risk from owning short-term bonds. Therefore, investors usually accept lower returns. 6 months later, in March 2019, yields on short-term bonds increased. The YTM of the shortest term treasuries are mainly determined by short-term interest rates. In the US, this is typically the Fed funds rate. This has risen as the Federal Reserve has slowly begun raising interest rates after the global financial crisis. Long-term yields have fallen. These yields are affected by the bond market's view on inflation. Higher future inflation means investors require a higher return to hold long-term assets. Raising short-term interest rates has had the effect of slowing economic growth, reducing the risk of future inflation.